Is President Trump on defense over the plunging and volatile economy? This story keeps kicking. America's largest companies are down, all of them in the market since the Trump tariff war began.
President Trump, a short time ago, telling Walmart that the company should, I'm quoting now, eat the cost.
Walmart reported its quarterly earnings, and it warned that price increases were coming later this month and into June. Walmart's CFO, John David Rainey, told me that they just can't absorb all the price increase. They plan to absorb some of it, and they said they expect their suppliers to absorb some of those higher tariff costs.
42.9%. Yes, you heard that right. The price increase in just 1 week. For a Barbie doll, you think it's just a random occurrence? Think again, because behind that is a chain of crises quietly affecting the wallets of millions of Americans. Price shock from tariff policies. In 2025, new tariffs were introduced, reaching as high as 145% on certain goods imported from China. Later, the tariffs were reduced to 30% through a temporary agreement. But don't think it's over. The real impact? Not small at all. Walmart, the largest retailer in the U.S., immediately felt the consequences. About 60% of Walmart's products come from China, ranging from electronics, toys, to essential foods like bananas, avocados, coffee, and roses. And all these prices are rising. A clear example, the price of a Barbie doll at Target surged by 42.9% in the week of mid-April 2025. This figure comes from Telsey Advisory Group. Imagine, with such an increase, each American household would need to spend an extra $4,900 annually just to maintain their current standard of living. This data comes from a report by Yale Budget Lab. More than a shock. Supply chain crisis and desperate reactions. So, what did Walmart do to cope? They couldn't absorb the extra costs from the tariffs. The company asked its Chinese suppliers to lower prices. But the result? China refused. And so, the shortage of goods and price hikes became even worse. And it's not just Walmart. Target, Dollar Tree, other major retailers in the industry also had to raise prices. What happens next? The shortage of goods caused shelves to empty, and according to the National Retail Federation, NRF, customer satisfaction began to drop. So what will consumers do? They'll have to spend more because all goods are becoming more expensive. Canada seizing the opportunity and strategizing. While American retailers are struggling with this situation, Canada is quietly taking advantage of the opportunity. Major Canadian retail chains like Loblaws and Canadian Tire have started attracting American customers searching for cheaper alternatives. Amazon Canada, not to be left out, has expanded its warehouse network near the U.S. border. This is a smart move as U.S. consumers are looking for affordable and quick products. Research from Statista and the Canadian Retail Association show that shopping demand from the U.S. to Canada is rising sharply, and Canada is fully prepared to seize this opportunity. Canadian Tire shifted 18% of its orders from U.S. suppliers to European suppliers within just 2 months. Very smart. This helped them reduce reliance on the U.S. supply chain and maintain stable prices. Opportunity or challenge for Canada? Although Canada is seizing this opportunity very well, infrastructure issues remain a major barrier. Montreal's port, which is in the process of expanding, may not be able to meet the surge in demand from the U.S. The fact is that the expansion process will take about 2 to 3 more years to fully meet the demand. To cope, the Canadian government has implemented a loan support program for large businesses to help them maintain operations during tough times. But can Canada improve its infrastructure quickly enough? If not, these opportunities could slip away.
That's right. The news here being that the Trump administration has told U.S. chip designers to stop selling their software to Chinese groups. Now, that's according to the Financial Times.
The United States is set to announce new restrictions on China's access to its semiconductor technology. While not fully disclosed, some of the measures include curbs on shipments to China of chip-making equipment and AI chips. Min Soo Kyun has this report.
The U.S. strategy, controlling technology to maintain dominance. The Trump administration directed American companies to halt providing EDA software, an essential tool for chip design, to Chinese firms. These companies command over 70% of the global market for chip design software, especially in the field of AI chips. The goal is clear: to slow China's semiconductor development, block access to advanced technologies, and preserve America's leadership position. However, this policy also disrupts global supply chains and reduces revenue for American firms. It creates heightened political and trade tensions, raising concerns among businesses and investors about the long-term sustainability of the global supply network. China's resilience and remarkable progress. Despite the restrictions, China has made significant strides in chip technology in 2025. Notably, Chinese researchers announced breakthroughs in carbon nanotube transistors, improving performance and practical applications. DeepSeek, a Chinese company, developed the AI model DeepSeek-R 10528, boasting impressive cost efficiency and computational power. Although details on GPU counts and costs remain limited, China is investing heavily, with a budget of approximately $48 billion, focusing on open architecture, RISC-V designs, and domestic lithography technologies. This effort aims to reduce reliance on imported technology and build a self-sufficient semiconductor industry. Global economic and financial impacts. The U.S. software supply ban has caused significant supply chain disruptions and impacted revenue for American firms like Cadence and Synopsys, who earn substantial income from the Chinese market.
All of the essential capabilities to advance AI, and they've made enormous progress in the last several years. Whatever policy the administration puts together really should enable us to accelerate the development of AI, enable us to compete on a global stage.
The global financial market reflects these changes through volatile capital movements and wavering investor confidence, particularly in the semiconductor sector, which is highly sensitive to political fluctuations. The risk of technological fragmentation. Two separate ecosystems. The U.S. ban contributes to the emergence of two distinct technology ecosystems, one led by the U.S. with its own chip standards and supply chains, and the other by China, centered around RISC-V architecture and homegrown technology. This division increases research and development costs, reduces international collaboration efficiency, and undercuts the benefits of globalized technology. Such a scenario risks igniting a tech Cold War, complicating geopolitical relations further and forcing companies to face challenges in maintaining global standards and compatibility. China's response and next steps. China has pledged to defend its businesses and warned of possible retaliatory measures, including restricting exports of rare earth materials, strategic resources accounting for over 90% of global supply and critical to the U.S. high-tech industry. Biden's administration is watching closely as Beijing continues to ramp up investments aimed at technological independence, strengthening its domestic chip ecosystem and cutting dependence on foreign tech. Moreover, China is implementing tax incentives and training programs to boost high-quality talent, enhancing production capacity and innovation. A challenging yet opportunistic future. Currently, there is no official update on whether the trade war truce set to expire in August 2025 will be extended or replaced. If no new agreement emerges, the technology war will likely persist, causing continued economic damage and deepening global supply chain disruptions. However, this challenge opens doors for multiple countries to develop independent technologies and diversify chip supply sources.
Always work to be very competitive from a pricing perspective and leveraging our strong portfolio. I'm very proud in this first quarter, we grew 2 points of market share. So we're going to continue to leverage our strong products across Cadillac, GMC, Buick, and Chevrolet, and we will be competitive in the marketplace. But right now, as we look going forward, we think the pricing environment is going to be much where it is right now.
General Motors is facing losses of up to $5 billion. And more than 50,000 jobs in the U.S. auto industry are at risk. But are tariffs really the main culprit? Tariffs, a double-edged sword, cutting deep into GM's costs. Tariffs of 25% slapped on imported auto parts were supposed to be a win for American jobs. Instead, GM is staring down a multi-billion-dollar loss. Take the Chevy Silverado, assembled on U.S. soil, yet burdened with an extra $3,200 to $3,600 in costs. These added costs force GM to raise prices, putting pressure on consumers already juggling budgets. This ripple effect forces GM to rethink production, pricing, and competitiveness, all under the shadow of these hefty tariffs. Production disruptions, layoffs tied more to demand than tariffs. You might think tariffs alone are firing workers, but the reality is more nuanced. GM's factories, Factory Zero in Detroit, Cami Assembly in Canada, are slowing output, mainly because people aren't buying as many vehicles, especially electric ones. Despite nearly doubling EV sales to 31,000 units in early 2025, GM missed the 100,000 unit break-even target. This shortfall causes temporary layoffs. About 200 workers at Factory Zero, over 400 at Adient's Tennessee plant. While tariffs add pressure, it's the interplay of soft demand and company restructuring that's driving production changes. So it's not all tariff fault. It's a cocktail of market realities shaking the industry. Electric vehicles, green dreams collide with rising costs. The electric revolution promises a cleaner future, but the road is bumpy. Tariffs on key battery materials like lithium and cobalt have boosted Ultium battery costs by 10 to 15%. That's roughly an extra $1,200 per EV. Combine this with shrinking government tax credits, and suddenly GM's EVs get pricier and less competitive. The company's goal of selling 100,000 EVs to break even now looks distant, with projections closer to 65,000. This means GM is racing against rising production costs and softening incentives. Workers and unions caught in a tug of war. The tariffs have stirred up tension among the workforce. Some workers rally behind protectionism, hoping tariffs shield their jobs. Others worry that rising costs and unpredictable hours mean less take-home pay. The United Auto Workers Union calls for defending American labor, but unions in Canada and elsewhere warn about fractured solidarity. This division isn't just about dollars, it's about trust, morale, and future bargaining power. Facing unstable schedules and shrinking paychecks, workers are caught between hope and frustration. How they navigate this struggle will shape labor negotiations and maybe the very future of manufacturing in North America. Ripple effects. When one link breaks, the whole chain wobbles. GM isn't alone in feeling the squeeze. Other giants like Stellantis, Volvo, and Hyundai grapple with similar pressures. Supply chains, already delicate, face disruptions that ripple globally. Consider a customs error in Ontario that cost a supplier $1.2 million in just 1 week. Freight costs have jumped nearly 20% since early 2025, squeezing margins even tighter. It only takes one glitch to halt an entire assembly line, causing layoffs and economic fallout beyond the factory floor. GM's future, navigating hope through uncertainty. GM plans to ramp production back up by mid-2025, aiming for 65,000 Ultium EV sales. But success depends on flexible tariffs and a smoother supply chain. If these don't materialize, production delays, low worker morale, and financial strain will persist. The future of GM and the broader American auto industry relies on managing these tangled challenges.
As you know, Mercedes and BMW and Volkswagen and many others, and we were restricted from selling cars into the European Union, which is not nice. And I just said it's time that we play the game the way I know how to play the game.
Cars. It's one of Germany's most important manufacturing sectors and is now under new U.S. tariffs. We're joined by Hildegard Müller, president of the German Association of the Automotive Industry. Hildegard, thank you for joining us. But start us off. Automotive tariffs from the United States are now underway. How significant are these fees?
I mean, these fees are overall a disaster for the free trade and for every market, not only for the European or Asian markets, but also for the American market.
Did you know? Profits for German cars like Mercedes and BMW dropped over 40% in Q1 2025 due to a 50% U.S. tariff. So, how does this affect you? U.S. tariffs and German automakers' response. Can you imagine? The U.S. slapped a massive 50% import tariff on all cars from the European Union. This blow targets giants like Mercedes, BMW, Volkswagen, Audi, and Porsche. This isn't just a tax number, it's a seismic shock shaking the free trade system. German automakers' profits plunged over 40% year over year, mainly due to disastrous sales drops in China, a critical market, combined with escalating trade tensions. But instead of giving up, these companies are fighting back. They're not pulling out of the US, the world's largest luxury car market, but temporarily pausing or limiting exports and restructuring supply chains. They're striving to keep prices stable, postponing hikes to maintain customer loyalty. Do you see how under immense pressure, German automakers are determined to hold their market share? Is maintaining prices and loyalty enough to weather this crisis? Production shifts and market impact. The massive U.S. tariff pressure forced German automakers to immediately change strategies. BMW ramped up production at its South Carolina plant to avoid tariffs, while Mercedes-Benz cut budgets and Volvo reduced staff and postponed new product launches. It's not an easy situation. So, how will American consumers be affected? Imagine luxury cars becoming increasingly scarce in inventory, longer wait times, and prices possibly rising by up to $10,000. Dealerships are cutting advertising, halting hiring, and preparing for a tough sales season ahead. Moreover, experts warn that the German economy could shrink by nearly 2% of GDP, the most severe decline since the 2008 crisis. This would also weaken the Eurozone and other key economic alliances, especially amid growing geopolitical tensions. What do you think about these major changes? How will the auto industry operate in the near future? EU's response and the risk of a full-scale trade war. Europe cannot stand idly by while the US imposes such heavy tariffs. The EU is preparing a massive retaliation package worth 95 billion euros, targeting US products like bourbon, motorcycles, aircraft, machinery, and cars. A strong response to Washington's actions, but it doesn't stop there. The EU has formally filed a complaint against the US at the World Trade Organization, citing violations of international trade law. This shows the dispute has moved beyond negotiations into the legal arena. Negotiations are set to conclude by July 2025. Without an agreement, the risk of a full-scale trade war is very high, threatening severe damage to both sides and the global economy. Do you think the EU will stand firm, or is there a way to prevent a large-scale trade war? Current situation and outlook. German automakers are closely monitoring and adapting to market conditions. They face a tough choice: shift production to the US and bear higher costs, or risk losing the crucial American market. The impact of these decisions extends beyond factories, dealerships, and workers. It affects consumers worldwide. What do you think will happen next for the German auto industry and the US market?
China's economic system, with growth driven by manufacturing exports, will continue to create even more serious imbalances with its trading partners if the status quo is allowed to continue. China can start by moving its economy away from export overcapacity and towards supporting its own consumers and domestic demand.
On May 26, 2025, China ordered an increase in the proportion of trade transactions conducted in the renminbi from 25% to 40%. Did you know? This means that $6.1 trillion in global transactions are beginning to move away from the US dollar. This is truly a turning point that has shocked the entire world. D-Day, May 26, 2025, China changes the global rules. On May 26, 2025, what seemed like a small decision shocked the world. China ordered banks to raise the share of trade transactions conducted in renminbi from 25% to 40%. Can you imagine? $6.1 trillion in global transactions began shifting, elevating the renminbi to a new status, directly challenging the reign of the US dollar. But China isn't just changing numbers. They're building a new future focused on high technology, artificial intelligence, robotics, semiconductors, the key industries to lead the 21st century economy. Moreover, they're expanding production and domestic consumption, determined to price exports in renminbi, creating a self-reliant value chain no longer dependent on the US financial system. Imagine this: a nation not only wanting to be the world's factory, but also determined to become the master of global finance and technology. How will this reshape the economic game? Are you ready to explore this transformation with me? US tariffs backfire. How China is leveraging to surpass. Did you know that in the first quarter of 2025, the share of payments made in renminbi surged to 30%? This is no small figure. It reflects massive capital flowing into China, while demand for US bonds continues to decline. More notably, countries like South Africa, Iran, and Brazil are proactively using the renminbi to bypass U.S. sanctions and restrictions. This signals a significant shift in the global financial landscape happening faster than we imagined. And what about the U.S. tariffs, reaching up to 145%? Do you think they would slow China down? Far from it. Those sky-high tariffs have only accelerated China's exports, especially in heavy machinery. They cut product prices by up to 50% and cleverly signed contracts in renminbi to dodge tariffs, gaining a strong competitive edge internationally. Are you surprised? Are tariffs still the shield protecting the U.S. economy like before? Or are they unintentionally pushing partners and markets into China's embrace?